students, today we're going to learn about options. It's super fun, I promise you.
This chapter will focus on futures and options on foreign exchange. Derivatives is something that is based on another source. It is an arrangement or an instrument, such as a future, option, or a warrant, whose value derives from and is dependent on the value of an underlying asset. Now, if you look up derivatives, you might get an explanation that it's a word derived from another or from a root in the same or another, depending on the language. So the derivative uses a benchmark that is tied to, and is contractual. So you buy a contract that specifies price, time horizons, and some other obligations. Because the derivative derives its price from another source, such as a currency, a commodity, or a stock, or its price will fluctuate based on that underlying asset. I created this picture as a way to simplify how to explain options. The option market is a zero-sum game. That means that there's one winner and one loser, just like flipping a coin. So in order to buy a call option, betting that the market will go up, you have to find someone that's willing to sell a call option who's betting that the price will go down. Likewise, if you believe the market's going to go down and you're going to buy a put option, the price will go down. You have to find someone that's willing to sell a put option, betting on that the price will go up. So this side is betting on you being wrong. Now, that doesn't always have to be that way, because the strategy of whoever is selling a call or selling a put might mean that they're looking at raising funds. So you're paying them money for a contract, and they can use that money to enter into a different contract. And by doing that, they might offset the risk of losing to you with winning against something else. Now, the reason why I have it blue here, red, and green has to do with the risks. So on this side, you have the opportunity to exercise your option, but you're not obligated to do so. So on this side, you only have the risk that the event that you were betting on didn't happen. Now, if you sell a call or sell a put, then you have obligations. If they lose, they have the obligation to actually pay out to you if you are on the buy side. So the sell side is much more risky than the buy side. Now, indirectly, why I say that this box is red to sell a call, if they're wrong and the price goes up, well, indirectly, infinity is the highest risk you can have. Now, on the contrary, when you sell a put, the biggest risk you have is the price goes down. And if you do that on a security, it can only go down to zero. So there's a limited amount that you can actually lose. You can price in how much they can lose total. Now, there's two ways how they can sell a call. One is that they just go naked, which means that they just write a contract. They might be required to have a margin account. That means cash put aside in an account that is used as a pledge to pay you if you win, or that you're right. Now, if you do a covered call or a covered put, that means that they already own the underlying security. Now, assume that you have stock in Apple, for example, and Apple happens to trade at $100, but you're concerned that something that you read about in the newspapers might cause the Apple stock to decrease. You still like Apple, you like the company, but you don't want to lose money on it. You don't want your stock portfolio to decrease in value. Then you can buy a put and use that put as insurance, so you limit the amount of money you lose. Say that you would actually put buy a put option on the Apple stock and say that you're only willing to lose $5. So you're going to buy a contract at $95, and that's your strike price, and say that you pay $1 for that contract per share, and each option contract size is 100, if you wondered. So that means that you have to do it for 100 shares. So you pay $100 for 100 little puts covering 100 shares, which means that in order for you to actually make money or protect yourself, it will have a strike price at a bottom of $95, and then your break even will be once the price goes below 94, because you have to put in the value of that option that you just bought. So indirectly, you must be willing to let the stock price decrease all the way down to $94 before you get any protection. So, but if the stock price would actually drop all the way down to $50, you can exercise that put option and get your $44 that will be paid out by whoever sold that put to you. Now, here's the cool thing. Assume that it drops down to $50 and Apple says, I think we're going to go bankrupt, and everyone's panicking. Then you can actually force them to buy your stock from them, okay? So that means that you can say, okay, initially I just wanted insurance, but the news was even worse than I thought it would be. So that means that you're going to say, hey, you need to buy my Apple stock, and they will have to do that, which means that you still get your $94 worth of Apple secured in price, regardless if it goes down to zero. Now let's look at the call side. Assume that you wish you had Apple stock, but you can't really afford the price. You don't have $10,000 to buy 100 shares of Apple, but you still would like to profit from the uptick in stock price. So that would mean that you would buy a call option on the Apple stock. Now let's continue with assuming that the stock price is $100 per share for Apple. You buy a call option at, say, 100 with the strike price of 105, and you pay $1 for that contract. That means that your break even will be the 105 plus the $1, so that's 106. Assume that the spectacular news that you were betting on happened and the stock price increased to $120, and you're in the money. At that point, you can say you can exercise your contract and get your $15 or $14 worth of profit. Or you can say, I want you to deliver the underlying stock. And at that time, you have $10,000. Now, because you had your call option written at 105 plus the $1, you can still buy the stock for $10,500. But the stock price is actually, or the stock is trading at a total value of $12,000. So that means that you can still get that stock. You can enter in that and either get the stock and buy the stock at the lower price that you now are able to buy for $10,500, or you just realize that gain of $14 times 100, which means that you made $1,400 on that call option trade. Let's do some terminology here. So in the money means that the buyer still makes the money on that trade. You're in the money. That's like if Apple stock will actually trade up to $120 with our example of your strike price of 105, plus it costs you $1 for the contract, so your break even is at 106. Or the other example where you bought a put and you had the $95 strike price and the cost of the option, which means that your break even is after $94. So assume that the stock price dropped to $50, you're in the money. Now at the money, that's when there's no intrinsic value. The seller makes the money. That means that you're not going to exercise this option. It's either trading at 105 in our example, or it's trading at 95 in the put example. Now, if it's out of the money, that means there's no intrinsic value. The stock price remains bouncing around, say 104 and 96 or something like that, and your option strategy is not working. So that means that the seller gets to keep the money. Now, a good example is that John Maynard Keynes mentioned that the market can stay irrational for so much longer than you can stay solvent, which means that you're going to run out of money. You're going to go broke. It might feel like you're broke, but you're really not. So that means that you can keep on your strategy, and at some point you run out of cash, and then you just have to sit back and hope for the best. And I'm guessing that you took the right trade, and that way you will actually make money in the near future. Some terminology on option contracts. An option gives the holder the right, but not the obligation, to buy or sell a given quantity of an asset in the future at prices agreed upon today. So in our example, you were interested in the Apple stock that in our example was trading at $100. Now you put it at a strike price of 105 for buying the call, and you set the strike price at 95 for the put, okay? And so for the call option, it gives the holder the right, but not the obligation to buy a given quantity of some assets at some time in the future at prices agreed upon today. But you can still exercise that option if you're making money on it, but not asking to have the stock delivered and paying full price for it. Same thing if you buy insurance on your stock. The put option gives the holder the right, but not the obligation to sell. If you still like the company, it's just at a lower price, but you didn't want to lose a bunch of money, you got the cash instead. But in your statement, it will actually say that you lost money on that stock, but your overall portfolio is not dented because you received cash. So that means that you a given quantity of some asset at some time in the future at prices agreed upon today. Now, there's a big difference between European versus American options. European options means that options can only be exercised on the expiration date. In the United States, options can be traded up to, including expiration date. And expiration date is always on the third Friday of every month. So when someone says that they're buying April contracts, that means that it will settle in just a few days from now, because today is April 14th, and that means that contracts will expire on the third Friday, which happens to be on Friday, a few days from now. So if you want to buy May calls or puts, it will be next month in this example. So American options can be exercised anytime up to, including the expiration date. And since options in the United States are so flexible, they have a greater value and maybe cost a little bit more than the European counterparts. Now, let's switch the terminology slightly and call it futures and forward contract. Now, futures are traded competitively on an organized exchange, like the over-the-counter, the OTC market. Forward contracts are traded by investment banks. And the big difference is that futures are a plain vanilla standardized contract. A forward contract is then tailored to your specific needs. The contract's size are standardized for an underlying asset. The forward is tailored for your exact needs, even to the penny if you so demand it. Now, the settlement date means that the futures automated daily settlement or mark to market. That means that every day it resettles. And that's especially if we do currencies. That means that you have to have a margin account that money is deposited into or withdrawn from as the price of the underlying security goes up and down. Now, in the forward contract, the participants buy or sell the contract amount of the underlying assets from the investment bank at maturity at the forward, the contractual price. That means that you don't have to worry about the mark to market. The mark-to-market could be challenging at times for accounting purposes if you're updating that on a day-to-day basis when it comes to assets or end of months or quarter. The expiration date on futures are standardized, and they also expire on the third Friday of each month. Now, the forward contract is tailor-made for the client. So if you need it to be on the end of the month or a specific date like June 18 or something like that, then you can do that. The delivery of the underlying assets is seldom made. You just want to make sure that your money is protected and you're either pay or you receive funds, depending on what the contracted statement says. Usually, if you dislike your transaction, and how you exit out of a contract is to buy the inverse of what you sold. By buying the inverse, the two contracts are identical, but one is buying a call and one is selling a call. They cancel each other out. Now, a forward contract, that is delivery of the underlying assets, and it is commonly made. It's because there's a specific need that needs to be completed. Trading costs. Futures, they have a bid-ask spread plus the broker's commissions that you pay. The forward contract is a bid-ask spread plus the indirect bank charges that are paying and is a compensation of the balance of requirement. Now let's look at some valuation. In the money, that means that the exercise price is less than the spot price of the underlying asset. At the money, the exercise price is equal to the spot price of the underlying asset, just like in the options that we discussed in the beginning of this video. Out of the money is the part where the exercise price is more than the spot price of the underlying assets. And once it has created intrinsic value, that means the difference between the exercise price and the option and the spot price of the underlying assets has created value for you. The speculative value is the difference between the option's premium and the intrinsic value of the option. Here's a simple example, a picture explaining the same thing. So here you're buying a call, and that means that you don't make any money until you hit that strike price, and you go a little bit past here just to break even, and then it creates intrinsic value and you're in the money and you're making money. Now the inverse of that looks it's the same picture but upside down. So they make money, whoever is selling it makes money until you hit your strike price and you pass the break-even point, and then they start losing money. Okay, so, and in this case they have an unlimited risk of losing money. Now if you buy a put, there's no intrinsic value in the beginning, and then you're hoping that the stock price, or betting, hoping that it won't or will, it's insurance in this case, right, will decrease in value, and once it decreases past your price point where you make money, you have intrinsic value. Okay, here. Now on the other side, your maximum loss is down to zero. Here's just a different, more textbook way of looking at things. Here's a stock or a price for option prices for Emerson. So you have the date, and you have the high and the low of the day, and the closing price, and the adjusting price of the stock. That's the underlying assets that's tied to it. And the price is roughly around here. So you have 41.67 is around right there, which means that if you bought a call option at with a strike price of 36, you would have to pay $5.70 for it. That means that your break-even point would actually be $41.70, which is 3 pennies above where it closed. So important parts to look at is, here's the strike price, the different prices that you can contractually go into. This is the cost of the options. Take a look here. If you bought an option with the strike price of $44.50, the price is a penny. That means that you can spend $1 and actually get the upside momentum of 100 shares for $1. Now, another part that's important to look at is open interest. These are the contracts that have happened, and here's volume. That's the contracts that have happened, and here's the interest of actually doing it. Now, it's always interesting to look at how many contracts has been exercised and how many are interested in betting on certain levels. Now, this is a very unusual part where over 100,000 shares is looking for someone to enter a contract with at a penny at a strike price of $45. Now the question is, and then you have another one for 50,000 here. So the question is, what do someone know on these two things here that you don't? Is there some sort of surprise news that is about to come out? Has someone done a mosaic type research and says, wow, they're going to have a record quarter and their stock price is going to easily go up to $50 on this news? Sometimes looking at these numbers here is called whisper numbers. Here we have the put options for Emerson. Still, stock price is $41.67. You have it here, and you're believing the price is going to decrease. And here you can look at the price range, and you can look at the volume, what's happening, and the open interest. And when you see that less people believing and betting that it's going to go down in value, you might say, that seems suspicious. And you might be right. It might mean that more people believe that market's going to go up than it's going to go down. So when you enter into put and call contract, you need to do your research so you know what you're actually putting at risk. Now, for any time, period of time when you go into a option trade, for whoever is selling the call or put option, time is their friend. It's called time decay, and typically the value of the option decreases the closer you get to maturity. So if you have a very long time horizon, if you buy something 120 days out, that might mean that you would have to pay extra in premium for that. And typically they would then call it a leap or a warrant or something like that. That's an option for a very long contract time. So in options, there's a lot of statistics, and each measurement has different Greek names for it. So theta is for time decay and is the enemy of an option buyer, but the friend of the option seller. So when you sell an option, the initial premium is your maximum possible profit for the investment. Every day that passes without your contract being exercised is one day closer to you realizing your full premium on that profit. Now, what makes the option market exciting is that you have so many different strategies. And here's a simple picture that explains the different strategies. George Soros had once said that the worse a situation becomes and the less it takes to turn it around, the bigger the potential upside of making money. A put spread is an option spread strategy that is created when an equal number of put options are bought and sold at the same time. The long straddle, for example, also known as a buy straddle or simply a straddle, is a neutral strategy in the options trading market that involves the simultaneously buying of a put and a call at the same underlying stock, striking price, and expiration dates. A call spread is an option spread strategy that is created when equal number of call options are bought and sold simultaneously. A butterfly profit from the long butterfly spread position. The spread is created by buying a call with a relatively low strike price and buying a call with a relatively high strike price and shorting the two calls with a strike in between. So how you profit in this option market has so much to do with the strategy that you are using. If you want to really learn about options, I recommend that you go to Morningstar, and they have an option class that is really well made that would teach you the key and most important parts of option trading. The class might be around $3,500–4,500, but you will learn a lot, and it's worth every penny.
Dear students, I hope you enjoyed this video on options. If you want to learn more, these two guys are really smart. They wrote the book, Follow the Smart Money. I suggest that you buy it and learn all about it. It will help you make money, and they have a really interesting concept, and it's about following the whisper number. Shh, don't tell anyone.